Welcome to another Southbank bulletin. So let's take another look at Credit Suisse, and it's down now to 80 cents, down $1 this morning. So when we think about what's happening in the world, well, interest rates have gone up a lot, and this is having a most particularly difficult effect on banks. And a good way to think about that is that just 2 years ago, there were trillion bonds that were trading with a negative yield. So when we think about that, it's not just a couple of trillion, it was 18 trillion. And in 2022, that fell from about 15 trillion to zero. So all those people that were buying bonds with a negative yield any time between 2019 and 2022 are sitting on fat losses. Now, it doesn't mean that there's a loss of 15 trillion, but when a bond moves from a negative yield to a positive yield, it means the price has gone down. We're in a situation today where over 90% of all corporate bonds have a price less than par. Now, what that means is that bonds are issued mostly at par, which is 100. And then when they mature, you get your 100 back. And in between, you expect to pick up a few coupon payments. But when they're trading below par, well, then it means that either those coupon payments are not big enough to compensate the investor for the risk of inflation, so that the 100 they get back in future will not be the same 100 that they gave in the first place, or it means that there's a lot of negativity in the market and investors just don't want to own bonds. But what I would then just bring to your attention is that the quantity of bonds with a negative yield is actually starting to rise again. So that does tell us that there is more demand for bonds coming back into the market, and then most particularly in Japan and in Europe. So now let's think about what's happening with UBS. Well, there was a shotgun wedding of sorts announced over the weekend, and UBS declined precipitously for the last 3 weeks and then bounced in here today. So they're going to buy Credit Suisse. And one of the reasons why Credit Suisse is in negative territory today is that there is some question about the bonds. And are those bonds going to be paid back? Now, when there is a question of wiping out bondholders in what are supposed to be Tier 1 assets. Now, Tier 1 assets is a term from the Basel Accords, and those were the international banking agreements. We've had Basel I, Basel II, and Basel III that were really intensified after the credit crisis in 2008. So Tier 1 capital is supposed to be the capital you can put on your balance sheet that is absolutely risk-free. Well, if those kinds of bonds are going bust, then it raises two important questions. The first is about the nature of Tier 1 capital in the first place. If the kind of capital that regulators told banks that they could hold is not risk-free, well, then it means that everything has to be reassessed, which of course begs the second conclusion, that if even your Tier 1 capital is going south, what about the Tier 2 and Tier 3 capital? Surely that is even more risky. So that is part of the reason why we now have central banks that are saying we're going to create even more dollar liquidity via the well-established swap lines. So swap lines are how central banks lend money to one another. Now, it doesn't mean that there's an immediate increase in the volume of cash in the system. But what it does mean is that there will be unlimited forms of cash available when they're required. And of course, what that means is that there is an open call on dollar liquidity, which means that there's going to be more dollars in circulation. And of course, that means that the dollar will go down. So that's what we're seeing right now. The dollar, of course, had this phenomenally large advance in 2020 and 2022. Then it declined, and we had a good sized rebound for about 6 or 7 weeks, and now that is rolling over. The more history we look at, then we can also just bear in mind that there is a bit of a cyclicality to the dollar. And if we look at the major peaks, once it peaks, then it generally will fall for about 7 years. And then when it starts to break out, well, then those breakouts also last for about 7 years. So what we've had over the last 2 years is a bit of an anomaly. And it's due a good sized decline. And and again, let's look at even more back history. If we are moving into a US recession, then the chances are that the dollar could decline meaningfully and it could come down to new lows. And if that's the case, we're talking then about the beginning of one of those 7 year periods of chronic underperformance. So what happens with the dollar over the course of the next few months, and most particularly if it fails to hold support around the 1,000-day moving average, will give us a lot of information about what to expect from the broad commodity complex and growth generally over the course of probably the next 7 or 8 years, which would take us all the way out to 2030. There's been a clear temptation to wonder, why haven't commodities been doing better? Well, commodities haven't been doing better because the dollar has been really very strong. But then also we have the question about global growth, and this the raising of interest rates and the withdrawal of dollar liquidity until now are quite likely to cause a recession. And oil prices broke downwards last week. So that is the culmination of a very short-term range, which is not normal for oil. Oil prices generally tend to be quite volatile. So when it goes sideways in an inert fashion for any kind of period of time, we can conclude that the breakout when it comes will be dynamic. That's what we had last week. Now, prices are a little steadier in here today, but this is still a downtrend. And the risk of a US recession is still high. And we're really only now at the beginning of the money printing trend. And then let's just think for a moment about the Nasdaq 100, because it has been trending in an impressive fashion for a decade. And on each of the major pullbacks over the course of the last decade, it has found support in the region of that 1,000-day moving average. And it is steadying from that region in here now. The two big factors that drove this outperformance relative to just about every other stock market in the world was that there was continued rounds of monetary accommodation coupled with the USA's coterie of technology companies. And of course, those technology companies benefit in a low interest rate environment. Now, if this trend is going to remain consistent, it is absolutely dependent on even more liquidity getting printed. And last week we saw that the size of the Fed's balance sheet popped on the upside. So this is very similar to the beginning of a new trend in monetary accommodation. And it would suggest that this is a topic that needs to be monitored closely. If we are now at the peak of the interest rate hiking cycle, and the Federal Reserve may well raise rates again this week, and that could easily be the last hike in this cycle, then the next order of operations is likely to be lower interest rates in future, more money printed in response to sharply lower economic activity, and then a boost to asset prices over the course of the next 18 months. I think with that, I'll leave you for this week and wish all the best to all of you.